Today, I'm going to discuss liquidity, which will help you enter trades with big money so you can boost your win rate and bank consistent profits. After spending over a decade in the markets, I've realized that liquidity isn't as complex as trading gurus make it out. I'll also simplify the 3 types of liquidity which have empowered my students worldwide to be consistently profitable and secure multiple 6 figures in proprietary funding. But first, you have to understand what exactly is liquidity. Imagine a swimming pool filled with water. The more water there is, the easier it is to swim, right? Well, that's similar to market liquidity. It's how easily we can buy or sell something without causing big waves in price. So, who's in the market pool? Well, retail traders like you and me mostly are trading a few thousand or a couple million and make up 5% of trading activity. Big players like institutions, banks, and hedge funds make up 95% of trading activity. See, they need a much deeper pool to make their big splashes without causing too many ripples, especially as they're dealing with hundreds of millions. If they want to sell contracts, they need someone on the other side of the trade to buy. And that's where retail traders come in. So why does liquidity matter? Well, think of liquidity like water in our trading pool. Without enough water, it's hard to swim smoothly. And if we can't find someone to trade with, it can cause price to jump up unexpectedly. Not fun, right? When you look at a price chart, think of it like a treasure map. There's going to be a ton of supply and demand on either side of the market, as there has to be some sort of a balance between buyers and sellers. And this balance is universal to any market. And if you can train yourself to read liquidity, you can trade with big money and avoid unnecessary losses. Remember, if you can't see the liquidity, then you are the liquidity. And now that you understand liquidity, let's look at the 3 common types of liquidity. First up is equal highs and lows. Mass market trading education teaches outdated, subjective methods of trading, like double tops, meaning price will reverse, or double bottoms, meaning a strong support. But here's the catch. A lot of retail traders follow these patterns, and institutions know they are, and actually take out the stop losses of retail traders. Equal highs form when price forms similar highs, which retail traders view as a strong resistance. But in reality, there's a cluster of stop losses above, which acts as resting liquidity. And what happens in real life? Well, price takes out the stop losses of retail traders and then continues in the initial intended direction. And similarly, equal lows form when price forms similar lows like this. And again, it's really a cluster of stop losses with resting liquidity below. But retail traders view this as a strong support. What happens in real life? Yet again, price takes out the stop losses of retail traders. The smart money fill in their orders, and then price continues in the initial intended direction. Let's look at an example of equal highs using this 4 euro-dollar chart. As you can see, price has formed similar highs, which has resting liquidity above. And let's see what happens next. Price takes out the stop losses of retail traders and then continues in the initial intended direction. Let's look at another example using this 1 hour pound-dollar chart. As you can see, price has formed similar lows, which act as resting liquidity. Many retail traders buy here, thinking it's a double bottom, marking a potential reversal. But let's see what happened next. Price took out the stop losses of retail traders and continued further down. These examples illustrate the importance of seeing liquidity to avoid stop loss hunts, which are the tagging of retail trader stop losses. And now that you've mastered equal lows and equal highs, let's move on to trendline liquidity. Traditional mass market education teaches retail traders to draw 3 touch points on trend lines, or support and resistance, and buy. But what happens in real life? Smart money know that retail traders are doing this and take out the stop losses of retail traders, and then price continues in the initial intended direction. So let's look at a chart example. As you can see, there are 3 successive lows connected by a trend line, and many retail traders would buy here thinking it's due for a reversal. But in reality, there's a cluster of stop losses below the low, and smart money often target these. So let's see what happened next. So as you can see, price took out the stop losses of retail traders and then continued in the initial intended direction. Many traders also subscribe to the idea that only once the trend line is crossed like this does that change the trend, and then they attempt to buy on retest like this. Remember, market structure takes priority over trend lines, and drawing trend lines doesn't add anything new that we can't see with market structure. And now that you understand trend line liquidity, don't dismiss the next type, which is range liquidity. And so this is the type of liquidity that forms in ranges around major swing highs and lows, as there's a cluster of stop losses. Also, breakout traders attempt to catch the breakout in the case of an uptrend, but also in a downtrend, which also adds to the liquidity. So very often, smart money takes out the stop losses of both the lows and the highs of the range before then continuing in the intended direction. So let's look at an example of range liquidity using this 1 hour Australian dollar chart. As you can see, liquidity was taken out on both sides of the range. This high took out the stop losses of retail traders above this high, enabling big players like institutions to fill in their orders. Then price came down like this, took out the stop losses below the lows, and then continued further down. Let's look at another example of range liquidity. As you can see, price action formed a sideways range, and to the upside, we have buy-side liquidity. So in other words, there's a cluster of stop losses here, and many traders attempt to long the upside upon a breakout. To the downside, we have sell-side liquidity. So many retail traders tried to short the downside, expecting to catch the move. So on both sides of the range, we have liquidity. And as you can see, this wick took out the stop losses of retail traders here, before then having this wick, which took out the stop losses of retail traders for these lows. And what happened next? Price then moved in the intended direction after liquidity on both sides of the range was swept. This is why we constantly see the highs and lows of a range being swept before significant market reversal. But it's important to not trade purely based on liquidity and to consider the overall market trend. Core market concepts like market structure, order blocks, take priority over liquidity, which should just be seen as a confluence. Trading is like driving a car late at night. Focusing on the end destination can be overwhelming, but if you focus on 100 meters at a time, eventually you will reach your end destination. So perhaps start with market structure, then move on to order blocks, and then liquidity. And this is exactly what I tell my students in my training program. Now that you've learned about liquidity, you still need to learn about market structure to be a profitable trader. So check out my previous video to learn more about that.